Prediction markets are officially crushing the old-school experts, calling the 50 basis point Fed cut with high confidence, while the pros were stuck at 25.
That is the core alpha from ARK Invest's Cathie Wood, who argues that real money bets on platforms like Kalshi are now more accurate than any Bloomberg survey.
We have condensed hours of analysis from Cathie Wood, housing expert Nick Gerli, and macro authority Jeff Snider into these high-speed AI summaries.
You will discover why 16% of home contracts are falling through, the reason a $10 billion credit fund just locked its doors, and why oil might collapse to $30.
Stick around to find out which zombie companies are about to go bust as we enter the biggest supply shock since the 1970s. Today we are looking at the latest Brainstorm session from Cathie Wood and the ARK team. And the big takeaway is that prediction markets are officially crushing the old-school experts.
Specifically Kalshi. Cathie Wood points out that while traditional surveys were lagging, Kalshi's real money bets were calling major economic shifts weeks in advance.
Wait, so people are literally betting their own money on things like interest rates and inflation?
Exactly. And because there is skin in the game, the data is coming in much faster and more accurately than a Bloomberg survey.
Here is the alpha. Cathie Wood highlights that Kalshi users predicted a 50 basis point Fed cut with high confidence, while the expert consensus was stuck at 25.
50 basis points. That is a huge difference in the finance world, right?
Huge. It is the difference between a soft landing and panic. But while we discuss how markets are winning, there is a massive blind spot in the tech sector we will reveal in a bit.
Stick around for that. But first, let's see why the wisdom of crowds is making economists look like they are stuck in the Stone Age. Cathie Wood's core thesis is that prediction markets have a 90% accuracy advantage because they filter out the noise of expert opinions.
Right? Because talk is cheap, but a $10,000 bet on Kalshi is a real signal.
So instead of listening to a guy in a suit on TV, I should look at what people are actually betting on.
According to Cathie, yes, it is about following the money, not the headlines.
It is the difference between a poll and a price tag. Let's dig into that Fed cut. Cathie Wood notes that Kalshi was pricing in a 50 basis point cut long before the Fed actually moved.
The traditional consensus was still playing it safe at 25, totally missing the underlying economic weakness Kalshi users spotted.
Hold on, if the experts missed it, does that mean they are just guessing?
They rely on lagging data. Kalshi users rely on real-time market pressure.
And that pressure showed the Fed was behind the curve.
So the crowd basically schooled the PhDs.
Cathie Wood also highlighted how these platforms are dominating election coverage.
She mentioned that during major debates or rallies, the odds on Kalshi shift 15 to 20 minutes faster than the breaking news alerts.
Wait, 20 minutes? In news time, that's an eternity.
Exactly. By the time the anchor tells you what happened, the market has already moved the price.
So if you're waiting for the news to trade, you've already lost the edge.
Note to self, delete my news apps, get a Kalshi account.
ARK's team found that even during peak volatility, the spreads on these markets stayed incredibly tight, around 5%.
That shows deep liquidity. People aren't just gambling, they are providing real price discovery.
Spreads? Like the difference between the buy and sell price?
Yes. A narrow spread means the market is very efficient and confident in the current price.
Cathie argues this makes it a superior tool for risk management compared to static economic models.
It's like a live speedometer for the economy, instead of a monthly report.
What does the future look like? Cathie Wood suggests that within 2 years, every major hedge fund will be using Kalshi as a primary dashboard.
It will move from a niche hobby to a standard institutional tool for hedging political and economic risk.
Does that mean the big banks are going to start betting on the election too?
They already are, but it will become much more formal and integrated into their trading algorithms.
The era of gut feeling forecasting is ending.
Good. My gut usually just wants pizza anyway.
Cathie also predicts that prediction markets will be the first to signal if we actually hit that soft landing everyone is hoping for.
Currently, the markets are pricing in about a 40% chance. If that number ticks up, it is a massive green light for equities.
40%? That feels like a coin flip.
In this economy, a 40% chance of things going perfectly is actually pretty bullish.
Watch that probability closely. If Kalshi moves to 60%, the bull market is in full swing.
I'll keep my eyes on the scoreboard then.
Cathie Wood's final advice? Stop checking the Fed calendar and start monitoring Kalshi interest rate spreads.
If the spread widens, volatility is coming. If it narrows, the market has consensus.
So, if I see the spread growing, I should probably buckle up for a bumpy ride.
Exactly. It is your early warning system for the next Fed pivot.
Also, watch for the gap. When the experts say one thing and Kalshi says another, follow the money.
The divergence is where the profit is. Cathie has used this logic to navigate ARK's biggest moves.
So when the experts are wrong, that's my chance to be right?
That is what Cathie Wood's data suggests. Betting against a lagging consensus is a classic winning strategy,
Just make sure you're on the right side of the trade.
Easier said than done. But at least now I have a better map.
We are looking at a total bloodbath in the housing market, according to Nick Gerli. He's reporting that 16.5% of home contracts were canceled in June.
That is the highest percentage on record for that month. Nick highlights that this isn't just a small dip, it is a fundamental shift in buyer behavior.
Wait, 16.5%? So nearly 1 out of every 6 people just walked away from their dream home.
Exactly. They signed the papers and then said, actually, never mind. It is a massive red flag.
And while the national average is bad, Nick Gerli's data shows Florida is getting hit even harder.
In places like Orlando and Tampa, we are seeing cancellation rates over 20%.
20%? That is 1 in 5. Why is everyone in Florida suddenly bailing?
Nick points to a toxic mix of high mortgage rates and exploding insurance costs. Nick Gerli's core thesis is that the math just doesn't work for buyers anymore. High rates are the primary culprit.
Right. When you combine a 7% mortgage rate with skyrocketing homeowners insurance, the monthly payment becomes impossible.
So people get through the inspection, see the final bill, and just run for the hills.
Pretty much. Nick notes that the cost of ownership has officially outpaced what the average family can afford.
It's a reality check that's hitting the market like a freight train. Nick Gerli points out a secondary effect. When these deals fall through, those houses go straight back onto the market.
This is creating an artificial surge in inventory. Active listings are climbing because houses are getting stuck in the system.
So the for sale signs aren't coming down? They're just staying up longer?
Exactly. They go pending and then pop right back to active a week later. Nick calls this a major inventory buildup.
And more inventory usually means sellers have to start sweating. According to Nick, the Sunbelt is where the bubble is popping first.
Cities like Phoenix, Las Vegas, and Austin are seeing similar spikes to Florida. These were the hottest markets during the pandemic.
Wait, so the places that went up the most are now crashing the hardest?
That is the pattern Nick is tracking. The easy money migration has ended.
The higher they fly, the harder they fall. Or in this case, the harder the contract hits the floor. It's not just older homes. Nick Gerli notes that new home builders are seeing massive cancellations too.
Builders are often stuck with spec homes that buyers can't close on because rates jumped during the construction phase.
So a builder finishes a house and the buyer says, sorry, I can't afford the loan anymore.
Exactly. Now builders are forced to offer massive incentives or price cuts just to move the inventory.
Which puts even more downward pressure on the prices of existing homes nearby. What does Nick Gerli predict for the near future? He is looking at a 10 to 20% price correction in these high cancellation zones.
If inventory keeps piling up and buyers keep walking, sellers will have no choice but to slash prices.
20% off a house. That's like $100,000 on a $500,000 home.
It is a massive loss of equity for sellers, but Nick says it's necessary to find a floor for the market. Nick also predicts that the power dynamic will fully shift to buyers by year-end.
We are already seeing it. Buyers are asking for repairs, closing costs, and price drops that were unheard of 2 years ago.
So if I'm looking to buy, should I wait for the bloodbath to finish?
Nick's data suggests that the peak of the inventory surge is still ahead of us.
Patience might be the most profitable strategy right now. Nick Gerli suggests watching your local zip code for a spike in active listings.
If you see listings up 50% year over year, you know a price drop is coming.
So, I just check real estate apps for the number of houses for sale.
Exactly. Look for the active count. If it's climbing, the sellers are losing leverage.
Another tip from Nick is to look for those back-on-market labels on listings.
Those are your indicators of failed contracts. Sellers with failed contracts are often more desperate to negotiate.
So back on market means I'm ready to deal?
Basically, it's a sign of blood in the water. Use it to your advantage. Jeff Snider is sounding the alarm on a $10 billion private credit fund that just locked the doors on its investors. 40% of those trying to get out are stuck.
Starwood Capital's S-REIT is the one in the crosshairs. They've slashed redemptions to almost nothing because they simply don't have the cash to pay everyone back.
Wait, lock the doors. If it's my money in a $10 billion fund, how can they just say no when I want it back?
That's the private part of private credit, unfortunately. Jeff Snider points out that when the underlying assets like office buildings lose value, the liquidity evaporates.
The big takeaway from Jeff's analysis is that 40% of investors couldn't get their money out last quarter. It's a classic liquidity trap.
40%? That's massive. Is this just one bad fund, or is the whole ship sinking?
That's the open loop here. While Starwood is the headline today, Jeff suggests this is just the first domino in a much larger commercial real estate collapse.
Exactly. If Starwood is struggling, you have to wonder who's next. We'll break down the systemic risk in a moment.
Jeff Snider highlights that Starwood dropped its monthly redemption limit to just 0.33%. That's a tiny fraction of the fund.
To put that in perspective, If you had $100 in there, you'd be lucky to get 33 cents back this month.
33 cents. I can't even buy a stick of gum with that. Why so low?
Because they're trying to avoid a fire sale. If they sell their properties now to pay investors, they'd have to accept huge losses.
So they're basically holding the investors hostage to save the fund's valuation. Jeff Snider explains that private credit exploded because traditional banks stopped lending after the Silicon Valley Bank collapse last year.
Right. Everyone thought private credit was the safe alternative, but Jeff argues it's just shadow banking with less transparency and no Fed backstop.
So we just moved the risk from banks to these private funds that can lock the doors whenever they want.
Precisely. It's the same bad loans, just in a different wrapper that doesn't have to report to regulators the same way.
And now that the economy is cooling, those alternative lenders are starting to feel the squeeze. The core of the problem Jeff points to is commercial real estate. Values are down 20 to 30% in some sectors.
And since these funds are loaded with CRE loans, their collateral is basically melting away.
Is this because everyone is working from home now? Those empty offices I see downtown?
That's a huge part of it. No tenants means no cash flow, which means the loan goes bust.
Jeff notes that as long as those buildings stay empty, these funds stay in trouble.
So my home office is actually crashing a $10 billion fund. Wow.
Jeff warns about a downward spiral. If one fund is forced to sell, it lowers the price for everyone else.
It's a contagion risk. If Starwood sells an office building at a 40% discount, every other fund has to mark their buildings down too.
Wait, so it's like a neighborhood where one guy sells his house for cheap and then everyone's property value drops?
Exactly like that. But instead of houses, it's billion-dollar skyscrapers.
Jeff's point is that we haven't seen the bottom yet because the selling hasn't even really started. Jeff Snider predicts we'll see more of this gating behavior. Starwood is just the first big name to break.
Other major players like Blackstone have faced similar pressure. If the redemption requests don't stop, the gates stay shut.
So if I have money in any private REIT, I should probably check the fine print right now.
Honestly, yes. Jeff's analysis suggests that liquidity is the #1 risk for the rest of this year.
The safety of private credit is being tested, and it's failing the first real exam. Jeff also foresees a broader credit crunch. When these funds stop working, small businesses lose their source of capital.
This leads to less economic activity, higher unemployment, and potentially a deeper recession.
So the locked doors at a rich person's fund eventually hurts the guy trying to start a bakery.
In the global economy, everything is connected. That's the Eurodollar University mantra.
Jeff emphasizes that the plumbing of the system is backed up, and it's going to take a long time to clear. Jeff Snider suggests watching the delinquency rates for commercial mortgages. That's the lead indicator.
If those rates keep climbing, it means more funds will have to gate redemptions to stay afloat.
Where do I even find that? Is it on the news, or do I need a special terminal?
You can track the CMBS delinquency reports online. It's public data, just a bit buried.
The big lesson from Jeff: in a crisis, liquidity is king. A high yield doesn't matter if you can't touch your principal.
Exactly. Don't get blinded by a 7 or 8% return if your money is locked in a vault for 5 years.
I've got it. I'd rather have my money at 0% and available than at 8% and invisible.
Spoken like a true student of Jeff Snider. Cash is a position, especially when the gates are closing. Today we are breaking down a massive warning from Doomberg, the anonymous analytical team that usually spots energy shifts before anyone else.
In a deep dive with Adam Taggart, Doomberg laid out why the current oil price is a total mirage, held up by war headlines.
Wait, the green chicken guy? I love that avatar, but are we really talking about oil collapsing while there's a war in the Middle East?
That is exactly the point. Adam Taggart and Doomberg discussed how once that geopolitical fear fades, the floor could drop out of the entire market.
According to Doomberg, the fundamental math for oil is actually bearish, despite what you see on the news.
Bearish. Everything I buy is more expensive. How can oil be oversupplied?
It comes down to production numbers that most people are ignoring.
Exactly. Adam Taggart highlighted that we are seeing record levels of supply that the market hasn't fully priced in yet.
Here's the headline. Doomberg believes oil could collapse to $30 a barrel once the Iran-Israel tension cools off.
Right now, we are sitting around $80, but Doomberg argues at least $20 to $30 of that is just a war premium.
Hold on, $30. We haven't seen that since the world literally shut down in 2020.
It sounds wild, but Doomberg points out that global demand is weakening while the United States is pumping more than ever.
And while oil might be headed for the basement, Doomberg teased a massive reversal in natural gas that we'll get to in a bit.
$30 for a barrel of oil. I might actually be able to afford a road trip again.
Adam Taggart brought up a staggering stat. The U.S. is currently producing 13.3 million barrels per day.
That is an all-time high. Doomberg notes that American shale has become the ultimate spoiler for OPEC's plans to keep prices high.
Wait, 13.3 million? I thought we were trying to move away from fossil fuels.
The rhetoric says one thing, but the pumps say another. We are producing more oil than any country in history.
So we have a literal ocean of supply hitting the market while everyone is distracted by the Red Sea.
So the scarcity we keep hearing about is basically a myth.
Doomberg also highlighted that OPEC and its allies are sitting on 6 million barrels of spare capacity.
That is like a massive shadow supply. If any of those countries decide to cheat on their quotas, prices tank instantly.
Why would they cheat if it makes the price go down for everyone?
Because they need the cash now. Doomberg told Adam Taggart that countries like the UAE and even Russia are getting restless with these production cuts.
It is a game of chicken, and Doomberg thinks the alliance is starting to crack.
6 million barrels just waiting to be dumped. That's a lot of oil.
Doomberg argues that without the Iran-Israel conflict, oil would already be in the 50s or 60s.
The only thing keeping traders from selling is the fear that a missile hits a refinery tomorrow.
So, we're paying a $25 fear tax every time we fill up.
Basically, Doomberg calls it the fragility premium. It is very high, but it's also very temporary.
Adam Taggart pointed out that if diplomacy wins, the speculators will exit their positions all at once.
And that is when the $30 target becomes a reality.
While oil looks bearish, Doomberg is actually getting bullish on natural gas.
They told Adam Taggart that as U.S. export terminals for LNG come online, we'll start shipping our cheap gas to expensive markets like Europe.
Wait, so oil goes down, but my heating bill goes up? That's not the trade I wanted.
For investors, it's a huge opportunity. Doomberg sees a massive divergence where gas prices finally catch up to reality.
So the green transition is actually just a gas transition, for now.
Seems like it. Doomberg always follows the pipes, not the promises.
Doomberg predicts the U.S. government won't aggressively refill the strategic petroleum reserve until prices drop significantly.
Adam Taggart noted the SPR is at historic lows, but the administration is playing the waiting game.
Why wait? If we need it, shouldn't we buy it now?
They want to buy low. Doomberg thinks they are eyeing that $60 level as the first real entry point.
But if Doomberg is right about $30, the government might look like geniuses for waiting, or like they missed the boat if it never gets that low.
I'll believe $30 oil when I see it on the sign at the corner station.
Doomberg suggests keeping a very close eye on the US dollar index, or the DXY.
Normally, a stronger dollar means cheaper oil. If the dollar keeps climbing, it puts even more pressure on that $30 target.
So if I see the dollar getting stronger on the news, I should expect gas prices to drop.
Eventually, yes, it's one of the strongest correlations in macro finance.
Lastly, Adam Taggart and Doomberg agreed that any sign of infighting in OPEC is your cue to exit oil positions.
When the cheating starts, the price war begins. And in a price war, nobody wins except the consumer.
Finally, some good news for my bank account. Thanks for the heads up, Doomberg.
Just remember, energy is volatile. Don't bet the farm on $30 just yet. We're breaking down a heavy discussion between David Lin and Kenneth Rogoff, a Harvard economist who says we are facing the biggest supply shocks since the 1970s.
Rogoff's big takeaway is that the era of cheap goods and low interest rates is officially dead. We are moving into a period of massive volatility.
Wait, the 70s? Like gas lines and disco? Is it really that bad?
In terms of supply disruptions, yes. Rogoff argues that deglobalization and geopolitical tension are rewriting the rules.
And while we tackle these supply shocks now, there is a massive debt bomb waiting in the wings that we'll get to in a moment. In David Lin's interview, Kenneth Rogoff identifies greenflation as a permanent upward pressure on prices.
Exactly. Transitioning the entire global energy grid to renewables isn't just hard, it is incredibly expensive and inflationary.
So, saving the planet actually makes my grocery bill go up? That's a tough pill to swallow.
It's a reality check. Rogoff notes that when you add deglobalization, moving factories out of China, everything gets pricier.
It's the reversal of the last 30 years of economic history. Kenneth Rogoff is adamant that the days of 0% interest rates are behind us for a long time.
He thinks real interest rates, that's the rate after inflation, will likely hover around 1.5 to 2%.
1.5% doesn't sound high. Why is everyone freaking out?
Because for a decade it was zero or even negative. When you have $300 trillion in global debt, every percentage point hurts.
Right? It's the difference between free money and money that actually costs something to borrow.
Rogoff pointed out to David Lin that global debt has ballooned to over $300 trillion.
300 trillion. I can't even wrap my head around that many zeros.
It's roughly 350% of global GDP. We are leveraged to the hilt.
And Rogoff warns that high debt plus high rates usually ends in a painful financial accident.
So we're basically an over-leveraged house of cards in a windstorm.
Another factor Rogoff mentions is the surge in defense spending due to geopolitical instability.
Nations are pivoting from just-in-time supply chains to just-in-case security, which is far less efficient.
Wait, So we're spending more on tanks and less on, I don't know, schools and roads.
Essentially, it's an unproductive use of capital that further fuels inflation.
Rogoff calls it a peace dividend that we've already spent and now have to pay back.
Based on the data, Kenneth Rogoff believes a significant economic slowdown is almost inevitable.
He's not just talking about a mild dip, he sees a period of painful adjustment where zombie companies finally go bust.
Zombie companies? Are we talking about a literal apocalypse now?
Financial apocalypse, maybe. These are companies that only survived because of cheap debt. Now, they're toast.
It's a Darwinian moment for the markets, according to Rogoff's analysis. Rogoff also predicts that the 2% inflation target is a pipe dream for the near future.
He expects it to bounce between 3 and 4%, driven by those persistent supply shocks we discussed.
Wait, so the Fed is going to keep hiking until we hit 2%? Or will they just give up?
Rogoff suggests they might have to accept a higher target or risk breaking the entire financial system.
Which means your cash is going to lose value faster than you planned. The main takeaway from David Lin and Kenneth Rogoff's chat: keep your eyes on real interest rates.
If real rates stay above 1.5%, high-growth tech stocks will likely struggle, while value assets might shine.
So I should check if my stocks are zombies before the rates go higher.
Exactly. Look for companies with actual cash flow and low debt.
Rogoff's insights suggest that traditional 60-40 portfolios might not cut it in this new era.
You need assets that can handle greenflation and geopolitical shifts. Think commodities or infrastructure.
So less crypto and more copper.
In a world of supply shocks, the physical stuff often wins out. Thanks for the breakdown, Kenneth Rogoff. Ken McElroy just released a massive study involving 10,000 renters, and the results are a wake-up call for the entire economy.
The core insight here, what we call the alpha, is that 52% of renters are currently struggling to make ends meet.
Wait, hold on. 52%? That is more than half the people Ken talked to.
Exactly. And while the rental market looks like it is hitting a ceiling, Ken warns of a massive renter trap that could trigger a second wave of housing issues.
Ken has decades of experience in property management, so when he says 10,000 people are feeling the pinch, it is not just a small sample size.
So he is basically looking under the hood of the economy by talking to the people actually paying the bills.
Spot on. He is bypassing the glossy government stats to see the real grit.
And what he found suggests that the soft landing everyone is talking about might be a myth for the average person.
The central thesis of Ken McElroy's discussion is the renter trap. 52% of his respondents are cost-burdened.
That means they are spending more than 30% of their gross income just to keep a roof over their heads.
Wait, if they are spending that much on rent, how are they supposed to save for a down payment to buy a house?
They can't. That is the trap. Ken highlights that high interest rates have made buying impossible, while high rents make saving impossible.
It is a vicious cycle. You are stuck where you are because you can't afford to move, but you can't afford to stay either. According to Ken McElroy's data, 60% of renters have completely given up on buying a home in the near term.
The combination of 7% mortgage rates and record high home prices has slammed the doors shut.
60%. So the American dream of owning a home is basically on life support for most people.
Ken's survey suggests so. People are staying in rentals longer, which you would think is good for landlords, but there is a catch.
The catch is affordability. If your tenants can't pay, it doesn't matter how full your building is. Ken also points out that the excess savings from the pandemic era are officially gone.
Wait, I thought the economy was resilient because people were still spending?
Ken McElroy argues that spending is now being fueled by credit cards, not actual savings.
Exactly. Credit card debt just hit a record $1.1 trillion. People are charging their groceries just to pay the rent.
That sounds like a ticking time bomb for the banking sector too, right?
Absolutely. It's all connected. On the flip side, Ken mentions that a massive amount of new apartment supply is hitting the market in cities like Austin and Phoenix.
We are talking about a 40-year high in new construction completions.
So, if there are more apartments, does that mean rent might actually go down for once?
In those specific Sunbelt markets, yes. Ken notes we are seeing concessions like 1 or 2 months of free rent.
But Ken warns this is temporary. Developers are stopping new projects because interest rates are too high, which means a supply shortage is coming back in a few years.
So it's a short-term win for renters, but a long-term headache.
One of Ken McElroy's darker predictions is a significant uptick in eviction filings over the next 12 months.
The data shows that delinquency rates on rent are already creeping up in lower income brackets.
Is this because the stimulus money is gone, or just the cost of living being too high?
Ken says it is both. When inflation for food and gas stays high, rent is often the first thing that gets skipped.
And since the courts are finally caught up on the pandemic backlog, those evictions will move through the system much faster now.
Ken predicts that the Fed will stay higher for longer, which will keep the housing market frozen.
If rates don't drop to 5% or lower, the renter trap Ken describes will only get tighter.
So basically, if you are a renter now, you should probably get used to it for at least another 2 years.
That is the reality Ken is seeing in the numbers. Mobility is at an all-time low.
It means less inventory for buyers and more competition for the affordable rentals that are left. Ken McElroy's big takeaway is for renters to look at local supply. If you see a ton of new buildings in your area, you have leverage.
Right. Don't just accept a rent increase. Check if the building down the street is offering 2 months free.
Wait, I can actually negotiate my rent. I thought it was just pay up or move out.
In an oversupplied market, the landlord is more scared of an empty unit than you are of moving. Use Ken's data to your advantage.
For investors, Ken suggests focusing purely on cash-flowing properties and avoiding speculative flips while rates are this high.
And for the rest of us, just try to stop using the credit cards.
Exactly. Ken emphasizes that liquidity is king right now. If the economy takes a dip, you want cash on hand, not maxed out cards.
The goal is to survive the trap until the cycle turns. Thanks to Ken McElroy for highlighting these boots-on-the-ground realities.
To kick things off, Cathie Wood makes a bold statement. Prediction markets are the new oracle of financial forecasting.
Absolutely. She argues that real-time bets on platforms like Kalshi are outperforming traditional predictions, which she finds outdated.
So basically, if I want to know what's going to happen, I should just follow those betting markets.
In a nutshell, yes, they're arguably more attuned to current sentiments and trends than any analyst report.
Next up, Nick Gerli points to a significant shift in the housing market.
He terms it the Great Buyer Retreat, warning that skyrocketing prices are turning potential buyers away.
So people are just throwing up their hands and saying, forget it. What does that mean for homeowners?
It could mean more homes remain on the market and eventually price corrections.
Moving on to Jeff Snider, a real alarm bell. He highlights the looming liquidity trap.
That's right. Jeff argues that higher interest rates are choking off liquidity, which could have dire consequences.
So, are we looking at a credit crunch? What does that mean for the average person?
Exactly. It means less lending, which slows down economic activity and could hit Main Street hard.
Surprisingly, despite their different focuses, all three experts urge caution.
Right, Cathie, Nick, and Jeff all emphasize that we need to be vigilant in this shifting economic landscape.
So no one's saying it's all good, just relax and invest.
Exactly. They're all on high alert for changes that could affect the market. Another spot of agreement, Cathie and Nick stress consumer behavior shapes market movements.
For Cathie, it's about how prediction markets reflect buyer sentiment, while Nick highlights affordability deterring buyers.
Wait, so they're both saying buyers are key. How does that play out in the data?
Exactly. If consumers pull back, it changes everything, signaling a shift in economic conditions.
And here's a big point. Everyone acknowledges that traditional forecasting is falling short.
Right? They argue that relying solely on old-school methods doesn't cut it anymore in this fast-paced environment.
So it's a bit like trying to use an old map in a place where the roads keep changing.
Spot on. They all advocate for new models that reflect today's realities. Here's where it gets heated. Cathie fully embraces prediction markets, but Jeff throws cold water on that.
Exactly. Cathie sees them as revolutionary, but Jeff is wary, citing their volatility and potential biases.
So Cathie's betting on the future, and Jeff thinks, hold on a second, what's the risk?
Precisely. Jeff believes more data and time are required to really trust those predictions.
A classic showdown. Nick thinks the housing market is at a peak, while Cathie sees signs of stabilization.
Nick warns buyers to be wary, citing affordability issues as a key indicator of a downturn.
But Cathie says, not so fast. She believes prediction markets signal a correction rather than a crash.
That's right. Their perspectives hinge on how they interpret the data at hand.
And here's another divide. Jeff sees a liquidity trap right around the corner.
In contrast, Cathie argues that innovation will lead us out of such traps by unlocking new opportunities.
So is Jeff essentially saying we're in trouble, but Cathie's like, not if you adapt quickly enough. What gives?
Exactly. It's a matter of whether you view the glass as half empty or half full.
Wow, what a whirlwind of insights. If you found this contrast of expert perspectives enlightening, hit that like button.
Absolutely. We strive to bring clarity from complex discussions, so don't forget to subscribe for more.
And share this with your friends. Trust me, they'll appreciate this savings in time for knowledge.
Catch us next time for more expert breakdowns and essential market insights.